Now we turn to execution. So we've set the foundation for how to do wealth management, but now it gets to actually implementing what you want to do. And before you execute a portfolio strategy, you need to ask yourself three questions. The first is, do you want to do everything yourself, or do you want to hire a professional manager? The second question is, are you going to be passive or active in your investing? I'll explain what active and passive mean. Active and passive can be at the asset class level. So do you want to be active in deciding between large cap stocks and small cap stocks? You can also be active or passive at the security level. Do you want to buy Apple versus buying Microsoft? Do you want to make those type of decisions? And you can mix and match the active and passive decision many different ways. And then the last one, which is somewhat related to the active investing, is whether or not you want to be tactical. That is, do you want to make investment decisions based on if you think stock markets are overvalued or undervalued? For most investors in the United States, if one does not have a degree in finance, is not spending a lot of time working on this, the answer is going to be quite basic. It's to hire a manager and be, for the most part, passive in your investing. There is absolutely nothing mediocre or taking the second place position because you don't have a degree in finance. Actually, hiring a manager and passively investing is not only an acceptable solution for most investors, it actually is a solution that has performed extremely well versus people who are trying to do it themselves and are trying to be active. And in fact, with retail investors, the data has shown people who hire a manager and invest passively do far better than retail investors who try to do it themselves and try to be active. If you're going to do it yourself, you're going to have to open up a brokerage account. We will see that if you're a passive investor, you might also want to have a brokerage account. I'll explain that a little bit later. If you're going to do it yourself, you're going to need a lot of time because you are going to need to perform a tremendous amount of analysis to decide which securities or which assets you are going to purchase. Usually you need about 50 to 70 hours a week to be able to handle this, especially by yourself, because the people you are competing against have teams of 100, 200 people. You think of a firm like JP Morgan, an army of 100 or more analysts with tremendous amounts of technology. They use things like Bloomberg, Capital IQ, FactSet. The typical retail investor does not have all of those resources. If you're going to do it yourself, you'll also need to monitor your performance much more closely and execute your own trades. Some people say they want to learn all of this, become more proficient in it, but it is very time consuming. So what a lot of people do is instead hire a manager, essentially outsource all of that. And you can essentially do that in three ways as a retail investor: through mutual funds, through your 401k plan or 403b, depending on where you work. Your employer may provide you a way to invest, and then exchange traded funds. Mutual funds were the big thing in the early 80s and 90s. Today, exchange-traded funds have become much more popular, and we'll talk about exchange-traded funds. I think they are actually the better solution over mutual funds, but to do an exchange-traded fund or an ETF, you will need a brokerage account. Not a difficult thing, pretty easy to set up, but it does create a little bit extra work versus mutual funds. If you're going to set up a brokerage account, there are many places to go. I use Charles Schwab, which is perfectly fine, works really well. This is Ameritrade. What I like about Ameritrade is they make it very easy to open what's called a paper portfolio. You can log on with them, provide all of the information, but say you just want to be a paper trader, which means you get to practice with funny money to see how well you're doing, make sure you understand the process before you actually do real life money. Other brokers may have something very similar. The wonderful thing about brokerages today is they just don't charge much money anymore. The brokerage account is practically free. It used to cost quite a bit of money to do a trade, to buy a stock or buy an ETF, but today it's practically free. So you can see there's a big button there in the middle that says open a new account. So if I were you and you're doing this new, I would stick with one of the big players like Schwab, like Ameritrade. Keep it simple. They're very good firms. They have very good platforms. And even if you're going to be a passive investor that buys passive funds, you probably will want a brokerage account so you can do the exchange traded funds. We'll talk about that more a little bit later. The best way to find a good manager is look at these 4 things. First of all is low fees. When you look at passive investing, the big advantage of passive investing is the fees are extremely low. If you do active investing, that is hire a portfolio manager who's going to try to beat the market, try to do trades to help you win, they have to charge more because they have to hire more people. The second thing you want to know is the turnover. How many trades is the portfolio doing? Study after study has shown that portfolio managers that you hire, the higher their turnover, the worse their performance. The next thing you want to look at, but is very difficult to find out because it's not reported by most mutual funds and ETFs, is the balance between gains and losses. The biggest mistake retail investors make when they try to do it themselves is they'll buy a stock and the stock will go up 10% and they'll say, wow, I did a great job, and they'll sell it too fast. Or they'll buy a stock and the stock falls 10% and they hold on to it because if they sell it, they have to admit they made a mistake. So they hold on to it. It falls 20%. They hold on to it. It falls 30%. They keep saying the stock comes back up to what I bought it, I'll sell it then. But they just keep holding it and holding it as the stock falls. So what you will find with the typical retail investor is their gains are really small and their losses are really big. Unfortunately, that's also true with many professional portfolio managers that you would hire. Because of the ego of trading, a lot of professional investors tend to sell their gains too fast and hold on to their losses too long. And studies have shown that firms, managers who have a balance between gains and losses outperform those who tend to have much larger losses than gains. The last one, which is also a little bit tricky to measure, but you could look this up, is how long has the portfolio manager that you are hiring, how long have they been that portfolio manager? One thing I learned in my career is there's an incredible impatience. A portfolio manager who is perfectly fine, has done a great job over the last 15, 20 years, but has a bad 2 or 3 quarters of performance, the industry tends to fire those managers very quickly. Not because it makes sense to fire them, but because it is very difficult to market a manager with recent bad performance. And that is how this industry is set up. It's not set up to make you money, it is set up to make them money. And they make more money when they can market a manager very aggressively. And the managers they can market are those who have recent strong performance. And that's the way the retail investor is. The retail investor tends to focus on recent performance. And so a manager who has had weak recent performance tends to get fired. But there are funds that will keep a good manager even during some bad quarters. That's one thing I learned about Vanguard. When I became a portfolio manager, I wanted to understand why was Vanguard so consistently the top management firm. I used to think it was because they were mainly a passive investor, and passive investing does really well, but when we look just at their active portfolios, they still rank number 1. And one thing I noticed with Vanguard is they have good managers who have bad quarters and they stick with them. They do not fire them. It's good to hire a manager that has been there a while and has a really good track record, even if their recent performance is weak. In fact, studies have shown, and we talked in a previous video about reversion to the mean, research has shown that managers with recent bad performance are more likely to do well going forward than managers with recent very strong performance. And that's just the nature of this business. It tends to ebb and flow, and to fire a manager just because they recently did poorly, you're probably firing them at the worst possible time. Here's two funds right here. On the left, you see Fidelity Contra Fund. That's an actively managed fund. On the right, we have the Vanguard Index Fund. That's a passively managed fund. Anytime you see the word index in the fund name, that's a passive investor. You can see here the turnover for Contra Fund is 25%. For an active fund, that's actually pretty low. I managed some funds that I did not care too much for that had turnover ratios well over 100%. I was stuck with that because that was the strategy for the fund. You look at passive investing tends to have very low turnover. You see for Vanguard, it's only 3%. That means they do not trade stocks all that often. They hold on to what they buy, and that makes sense for passive investing because they're passive. They're buying the stock market and just holding on to it. The second thing you'll notice is fees. You can see with Fidelity, their fees are 0.55%. That's also known as 55 basis points. The category is 99, so they are much cheaper than the category. Something else that's real important are the load fees. You can see Fidelity does not charge load fees. A load fee is terrible. You never want to hire a manager that charges a front end or deferred sales load. If you give them $100,000, they're taking $5,000 of your money up front and still charging you 1% a year. And then when you exit the fund, maybe a few years later, they're going to take another 1% from you. That's a terrible way to invest money. Vanguard, their fees are only 2 basis points, a small fraction of Fidelity. That's the advantage of hiring low-fee managers. They start off with a huge advantage. They will outperform just because their fees are lower. You can see some other information that's here. One thing people tend to focus too much on are the Morningstar ratings. You can see Vanguard is a 5-star fund. Fidelity Contra Fund is a 4-star fund. I'm not a big believer in Morningstar ratings. We did a study several years ago that showed that they really don't predict future performance. I don't know if that's changed recently. I haven't done a study in a while. But Morningstar ratings are entirely based on historical performance. And historical performance is actually a very poor predictor of future performance. So the Morningstar rating tells you it's a manager that's done well in the past, but really does not give you much indication on whether the manager will do well going forward. So what is passive investing? Passive investing is you just buy the market. Very low cost, and it eliminates manager risk. And I'll tell you right now, if you're trying to find a good manager, and I think the Fidelity Contra Fund is a very good fund, it has done very well over time, but I have discovered over time when you go out to try to find really good managers, it is very difficult. You find a manager with a good Morningstar rating that has done well the last 5 years, and inevitably the next 5 years they'll do terribly. It's just a frustration of trying to find active managers. If you want that workload, it's very difficult because there are thousands of active managers. How do you find the ones that do well? And unfortunately, there is not much data that actually helps you with that. I'll show you in a later video how I do what's called manager attribution. If you want that Excel spreadsheet, you can use it to assess your managers. It's so much focused on the past, and you're really interested in the future, and very few of the statistics that we use to assess managers work well for predicting the future. They just tell you how the manager has done in the past. So manager risk is first that it's really tough. Passive investing, I think, makes sense for the overwhelming majority of retail investors. Saves you a lot of money because they're low cost, and you're likely to do very well, and it's a lot less time consuming. Active investing, you're going to try to beat the market. So you are going to have to pay more to try to find, and I put the word reliable in quotes because it's very difficult, but try to find reliable, superior performance. Very, very difficult to do. There are studies about passive versus active investing. This is a study that comes from Standard & Poor's. Just to let you know, Standard & Poor's makes a lot of money from passive investing because they sell their S&P 500 indexes and other indexes to passive investors. Then the market the funds as passive, and so they prefer passive investing, but I think this is a reliable study. And as you can see from this, what this is showing is the percentage of active managers that underperform the market. And you can see most years over 50% of them underperform the market. And that makes sense because they charge higher fees. The market doesn't charge fees, it's free. You saw with the Vanguard fund, they charged 0.0002, 2 basis points, practically nothing. And they make all of that back by doing what's called securities lending. Essentially, the Vanguard funds are free. So no fees, whereas you hire the Fidelity Contra Fund, you pay 0.55%. You start with a disadvantage. So the majority of the portfolio managers out there underperform the benchmarks. You can see in 2021, 85% underperformed. In 2022, one of the better years, about half the managers outperformed, half underperformed. Now that's year by year. Here's 2022. You can see the majority have underperformed with the exception of fixed income funds. Here are some scales that show us over a 20-year period and showing the number of funds that have underperformed. You can see in every category over 20 years, active underperforms. Now you might say, okay, there's a few that outperform. You see those little blue percentages, 3%, 4%. So you say, well, why don't I just hire those managers? Well, the problem with that is just by statistical noise, just by random chance, if it were entirely random, you would expect about that percentage to outperform. May have nothing to do with the superior manager, superior process. It can be entirely random luck. Look at the large cap growth funds. You can see almost none have outperformed. Less than 1% have outperformed over 20 years. There are some that do better, like real estate funds. But even then, you're better off. If you're passive, you're in the orange. So you can see if you're a passive investor, over time you have a much higher probability of doing well than if you try to go active. And I'm talking about even if you have a great process, you spend a lot of time looking for active managers, you're still far better off doing passive investing. It's just so difficult to beat the market as an active investor. Here are some very famous passive index funds, some famous active funds. You can see their tickers. Their tickers are just like stock tickers. You can buy them as just like you would buy a stock. Usually you go to the firm, you go to Vanguard, you go to Fidelity, and you buy their mutual funds from their sites. Some of these are quite large funds. You can see this Vanguard fund is $1.3 trillion. This is a really good fund. It buys all the stocks in the U.S. market. So it looks like the entire U.S. stock market, and it costs you just 3 basis points. That's 0.0003. Very, very low fee. Then you get into active investing. You see that Fidelity does both passive and active. Their passive funds are very cheap, just 1 basis point, whereas we saw with their active funds, 55 basis points for the Contra Fund, 45 basis points for the Magellan Fund. You can see some funds are very expensive, 139 basis points. That's 1.39%. So if you give them $100,000, they're going to charge you almost $1,400 a year to manage your money, where you could just pay a very small fraction of that and go passive. So American funds, Fidelity, Dodge & Cox, T. Rowe Price, these are all perfectly fine firms, but you do pay up for it. What I'll do next is get into the actual execution of how you do this once you get your brokerage account and show you how to get going.